Thanks for joining us. I'm Nisa Darbon, Executive Editor at Large for Hart Energy. I'm visiting with Gene Shepard, CEO of newly minted VTEX Energy Partners. Many of you know Gene from his legendary 40-year to-date career as a wildcatter for the Bakken, for the Delaware, for the Rockies, and now with VTEX, he's looking for some new prospects. Gene, first, thanks for joining us.
Absolutely, thank you.
And secondly, so you've traditionally wildcatted for oil. You've traditionally invested in oil. What you're looking at rolling your backing by Vitol into, would you consider gas?
Absolutely. Yeah, there's no question that we would. Vitol, despite trading a lot of barrels, they're sort of commodity agnostic. They're just really looking for inefficiencies in the marketplace. And so, interestingly enough, probably since the beginning of the year, about half of the opportunities we've been looking at have been on the gas side. And some of that's a function of the basins we've historically been focused on, both the Permian and the Williston. The Williston is more of a mature basin now, and the Permian is, it's expensive, and so the opportunity there's still opportunity in the Permian. It's just there's a lot of companies competing for those opportunities. So we're maybe spending more time looking at maybe out of favor basins and are looking at gas in those out of favor basins. It's at the top of the list, particularly given the outlook for the gas prices now.
And in terms of where you're looking, are you looking for, like prospect level exploration opportunities? Are you looking for a property that's fully delineated but
Right.
has not yet been exploited?
Right.
What stage of development or, the
Right.
cycle are you looking in?
Well, I don't think, the environment is such that there's just not great capital formation on the exploration side of the business today. I think that's going to have to change because we're running out of drilling locations. So where we are focused currently is, and some of it's there, maybe last year there was just so much opportunity and so little capital that you didn't have to take exploration risk. You could go buy something and earn, buy PDP and an inventory of drilling locations and generate an attractive rate of return. So, but it's, as I said, as the universe of drilling locations depletes over time, then we'll run out of opportunity. But at the present time, I think there is adequate opportunity. That's primarily a function of there's just not great. It still feels very challenged in terms of capital formation. And so that's really, there's been so much capital flight out of our industry that's really opened the door for us. And we're looking at larger opportunities, north of $1 billion, and there's very limited, capital formation at that size. So, and that's a conscious strategy on Vitol's part to try to, that's a more inefficient segment of the market today, doing a larger transaction. A lot more competition for $100 million kind of opportunities.
It came up earlier today. There is this kind of gap in startups to acquire because private equity went from backing, let's say, 10 new startups a month to finally fewer than 10 in a whole year.
Yeah.
So has this, it's not generational gap, but let's say investment gap created, sparse opportunities out there?
Well, it's really just there's so little capital. And so public investors aren't hugely constructive to the industry, and you've had a lot of private equity, traditional generalist private equity firms, particularly the New York-based firms that have gotten out of upstream. And so the diminished pool of capital means that you've got a diminishing pool of opportunity until we start spending exploration capital today, but there's so little capital that there's ample opportunity for the capital that is available, if that makes sense. Does that make sense?
Yes. Thank you, Gene.
Yeah, thank you.
And thank you for joining us.